talk about inflation today. The title is Inflation is Coming. Should we fear it? This has been a topic that's been all over the news, and we'll talk about that a little bit. I think we got a pretty big crowd today, but we'll bump along and get everything kind of ticked away before we get started. Please ask questions, everybody. Y'all, those of you who have been on here before, I'm not a mind reader, despite what my wife thinks. So we really want to know what's on your mind, or if there's some things that you don't understand. It's very helpful because I'm not a great communicator, and I may parse over something too quickly. So please ask us questions. It's really, really, really helpful to us. And as always, we're recording this telecast. It'll be up on our website. And if you know someone who might benefit from this, please forward it to them. We'd love to get the word out as usual. And I would be remiss if I didn't mention happy birthday to a particular attendant who's on our cast today. He knows who he is, so I'll save him embarrassment. But happy birthday, Gil. Hope you're having a great day. So with that, let's get started. I'll share my screen here. As a reminder, the format for this is we usually chat for about 20 minutes, and then we leave it open for Q&A, and that's really where the fun is. So any questions that you may have about what we're talking about today or anything else, there's absolutely no constraints on what questions you might ask. So let me get this thing queued up here. Hang on just a second. You'd think after doing Zoom for a year now, I'd be much better at it than I am, but I sort of bump along. So today is inflation is coming. Some would say it's already here. Should we fear it? This has been a question we've had from a lot of clients and a lot of folks and a lot of future clients. So we certainly wanted to talk about it, and it's all over the media today. So 4 things we're going to talk about with regard to inflation today. What is the effect of inflation? Which is worse, inflation or deflation? We're going to give a historical perspective on inflation. And for those of you who have a little white hair, you'll remember the late 70s and early 80s when interest rates were through the roof. We'll touch on that because I think in the background, that's really what everybody's fear is. Are we going back to those crazy times? And then we'll talk about the pros, the cons, and the strategies that you might use to deal with inflation. So let's get started. So this is the cover of Barron's this week. We love Barron's. Barron's is a great magazine. It's a subsidiary of the Wall Street Journal, but you can see the I word is the cover of Barron's. Now, Barron's is a reputable magazine. We like it very much, but it is given to selling by talking about inflation because that's what the media wants to do. They want to get people fired up about inflation. So what are the effects of inflation? Well, here are 5 of them. Inflation erodes purchasing power. And the simple explanation of that is that if we're paying $3 for a gallon of milk right now and inflation goes up, in the future, we're going to pay $3.25 for a gallon of milk, or it's going to take more of our disposable dollars, and that's going to eventually erode our purchasing power. The cost of goods goes up, and that's what we feel immediately, and some of us are feeling that now. Another effect of inflation is it raises the cost of borrowing. So if we have loans outstanding that are variable rates, or if we have loans outstanding that are tied to a particular rate, the cost of borrowing is going up. About a year ago, home mortgage rates hit their all-time lows. For those of you who are looking at home mortgages, they have crept up a little bit, but they're still very, very, very low. Next is it pressures stocks as they become less competitive from a return perspective, from particularly fixed income. And what I mean by that is, let's take the example of a utility stock. We'll use Southern Company. Southern Company, which runs Plant Vogtle right down the road, yields about 4%. Well, those of you who've been on my recent calls and Zooms previously know that the 10-year Treasury is yielding about 1.5%. It's yielding about 1.6 now. A year ago, it was yielding 0.6%. So when you compare a yield of a 10-year treasury bond that pays 0.6% with Southern Company that pays 4%, you're going to buy Southern Company because you can get a much better return from an income standpoint. So when inflation goes up, the flip side to that is interest rates go up. And so when interest rates go up, stocks become less attractive because with much less risk, you can make a better return on your investment. We'll touch on that again here shortly. The other interesting thing is oftentimes inflation leads to more inflation because of a scarcity mentality. So right now, and think about the toilet paper during COVID, people started buying toilet paper and hoarding toilet paper. And recently, in the Southeast in particular, when the Colonial Pipeline was sabotaged, everybody went to go get gas, although they didn't need to. So the same thing happens with inflation. As prices go up, people are fearful that prices will get even higher. So they go to buy things even more quickly, probably faster than they needed or ahead of what they needed or more than what they needed. And that drives the price up even higher. One of the good things about inflation is it reduces unemployment. We'll talk briefly about this. The employment, one of the leading indicators of inflation are increased labor wages. As a matter of fact, economists look at that closely, more closely than any other things. So if all of a sudden, as an example, we now have a $15 minimum wage, just figuratively, then more people are going to apply for jobs, and that will ultimately reduce unemployment when labor cost goes up. And aside, y'all have heard, those of you who are clients of ours, our biggest challenge over the last 3 or 4 years has not been the equity side, but it's going to try to find fixed income investments that pay a decent rate of return. So the flip side to higher inflation, as I mentioned earlier, is interest rates are going to go up. And if interest rates go up, it makes our job a little bit easier, particularly on the fixed income side or the bond side, because we're looking at how much risks do we want to take? That risk being, will this bond be paid off versus how much interest it's paying? So that relationship is going to be the higher the risk that the bond may not be paid off, the higher the interest rate. So as you'll hear me say, in some regards, we welcome a little bit of higher inflation, which leads to higher interest rates. So as I was putting this together, I wanted to talk about deflation as well as inflation. So what is deflation? Deflation is a fall in the overall level of prices in an economy and an increase in the purchasing power of currency. We in the United States have not had deflation over the last 10 years, but we've come darn close. When our 10-year treasury rate that I referenced earlier gets down to about 0.6%, we are very close to deflation. And deflation in many regards can be scarier than inflation. So as an example, the next bullet point, currently Germany's 10-year treasury bond, I said right now, the US government 10-year treasury bond pays 1.6%. Currently, Germany's 10-year government bond pays negative 0.112%. That was as of close of today. So if you go buy a German bond today, you're going to pay the German government to hold your money. And that is deflation at its finest. And it's gotten better because, as you can see, a year ago, the German 10-year treasury was paying negative 0.5%. So you were giving up 0.5% just for the German government to hold your money for 10 years. Another point about inflation versus deflation is inflation, believe it or not, can be controlled slightly better than deflation. And what I mean by that is, in a deflationary environment where prices are falling, the Fed in particular has limited ammunition. They go buy bonds, they go provide liquidity to the market to keep interest rates from falling too much further. But when inflation is in check, the Fed very easily can raise interest rates, and that usually will actually slow down inflation. And here today, for those of you who've been reading, there will always be inflation or deflation. There's never a perfect level. We have to make peace with the fact that we're always going to be in a slightly inflationary or slightly deflationary or inflationary or deflationary time period. There's no perfect medium there, but they're both temporary. For those of you who have been in the office with me and in meetings, you've heard me say many, many times, and our team as well, everything is cyclical. It's the same with inflation and deflation. So right now, think transitory, to quote the Federal Reserve Chairman Jerome Powell. Right now, the Fed is saying, for the most part, and they came out with some news today that we'll touch on in a minute, that this inflation that we have is transitory. That's the word of the day. So pay attention to that. You'll hear that some more. So here's a historical perspective. You know, I always have to have one chart in my presentation, or it's not a Gene McManus presentation. This is CPI, or Consumer Price Index, from 1958 to 2020. So the blue shows CPI, and then the yellow is core CPI. Core CPI excludes food and energy, and you'll hear that often because food and energy tend to be more volatile than everything else. But this is an incredibly important graph. So we can see that basically between 0 and 5% has been inflation for almost the last 60 years, with one exception. And I think my cursor will work here. So right here in 1975, 1976, we had a very high increase in inflation, up to almost 13%, okay? Then it came back down to a somewhat normal range. And then towards the end of the 70s and the beginning of the 80s, that's what we gray-haired folks all remember, is mortgage rates of 18%, but you could go buy a one-year CD that would pay you 15%. The important point here is you could not buy a 10-year CD that would pay 15%. And the reason for that is what I referenced earlier. It's all very cyclical. Everyone knows that that's an abnormally high interest rate, and at some point it would come down, and so it did. What I want you to see here when we're reading about inflation and everybody's getting stoked up, pardon the pun, is that except for a 10-year window there, and really out of that 10-year window, about 6 years, we had abnormal inflation over the last 60 years. That's a long time. So about 10% out of that 60-year time period, we had abnormal inflation. So as you read stuff and you get concerned about it, I'm not saying inflation is a good thing. It's not necessarily, but remember that 60-year time period. So let's talk about some pros and some cons and some strategies of it. So the pros, I mentioned earlier that one of our challenges has been trying to generate income in the fixed income area, and fixed income are CDs, bonds, municipal bonds, those sorts of things. So as we see interest rates rise, i.e. inflation goes up, they usually move hand in hand. We will see yields on CDs, bonds, and other fixed income instruments move up. That's a good thing. Another pro is, as I mentioned earlier, labor costs are one of the leading causes of inflation. When inflation moves up, typically unemployment is going to move down because right now we hear it all. There's many, many causes of folks trying to place people in jobs. That's a big difficulty and a headwind for many businesses. And it's really based on three factors. One, there's a lot of money out there in the form of stimulus that is an incentive for folks not to work. Two, COVID is still around and people are concerned about catching COVID at work. And then three, childcare for those who have to go to work. It's just a perfect storm in many regards. But as that per hour or the cost of labor or what people can make goes up, those jobs are going to get filled. It's supply and demand. One of the cons that I mentioned earlier is most items are going to become more expensive. Not everything is going to become more expensive. We think about lumber right now. Let's use that as an example. So lumber right now, I think it's 3 times what it was just a year and a half ago. So that's beginning to squelch home starts, home building, constructions, real estate development projects. So as that moves up, the cost of lumber eventually will come down because of 2 things. One, the big cause of it right now are sawmills. There's not enough sawmills to produce the lumber. The cost of the raw lumber or timber has not moved in the last 30 years, but they're not able to saw or cut the lumber. Either more sawmills will be created or fewer people will begin using lumber and prices will eventually come down. Again, it's going to be cyclical, just as I showed in the previous graph. So strategies, many of you are probably on here to find out, I'm scared of inflation, what should I do? Well, a couple of things here, tips, Treasury inflation protected securities. They will match or move with inflation as it moves up and moves down. Right now, you're not going to get a good return on them. You may get a better return on them as they move up and move down. Not very sexy, but if you're concerned about inflation, that's a place to look. Another place is real estate. And probably the best, I'm not talking about going out and buying a house, but things like real estate investment trusts or trusts that invest in commercial or residential real estate where rents will move up. So as inflation moves up and the cost of goods and services goes up, those will keep pace with inflation, those 2 things. But as you've heard many times before, your asset allocation based on your risk tolerance and your time horizon is the most important course to follow. Because as I illustrated in the graph that we just saw a few minutes ago, everything is cyclical. We're going to have some inflation, but we've been desensitized almost to interest rates over the past, probably going on 10 years now. And so any rise in interest rates is something that is going to catch our attention. So as I begin to come in for a landing, as I conclude, how do we approach here at AP Wealth Management inflation? We're watching it, we're concerned about it, but we are coming out of a global pandemic where demand went almost to the floor. People quit buying things except Pelotons and exercise equipment. We didn't go out to eat, we didn't do anything. Now we're slowly coming out of that. It looks really good right now. And so we have so much pent-up demand, and our system to deliver those goods has been docile for a year almost. So now we've got huge demand, money in people's pockets, and a delivery system that is not well oiled. Of course, we're going to have inflation. Our contention is that it's likely transitory. We will look at things to protect against inflation, but we're not going to make big bets on us going back to the late 70s and early 80s because we don't think that's what's going to happen. We think we're probably going to have a resumption to a more normal interest rate. That being, as I said, the 10-year Treasury right now is about 1.6. If the 10-year Treasury got up to 3 or 3.5, that's more normal. We don't think that's going to happen tomorrow, but at some point it probably will happen. And we hope that it will, because in many ways it'll be beneficial to us. So a really interesting topic, one that I hope there's a lot of questions about. So I will stop my sharing and entertain questions that I know you must have. And before I do that, I've also got Clayton Kwame on the, there you go, Clayton, on the call, and probably another team member too that I'm missing. So Millie, if you can help me out there, that's great.
Yeah, we have a question already, Jane.
Good.
So this person said, I am reading that banks are preparing for inflation and devaluation of the US dollar and possible move toward a federal digit dollar. What is your opinion of this and the effect on those of us who have large sums of cash in banks?
Great question. I would really be shocked if we move to a digital currency. I know Clayton and Tom did a great job talking about cryptocurrencies last week and talked about Bitcoin as well as some others. The banking system is not prepared for that. So that's the news. The good news is up to $250,000 is FDIC protected at banks. And if you're holding cash in an inflationary environment, that's not necessarily a bad thing. And let me tell you why. So the dollar, the US dollar may be devalued. We are still the cornerstone currency by far and away of the world. When people have trouble and countries are doing poorly, or they want to make their funds safe, they buy dollars. That's not going to change anytime soon. So I would not be concerned about your dollars being in the bank. I would not be concerned about us going to a digital currency. I'll repeat this. I think Clayton and Tom probably talked about it. If we went to a digital currency, the first question is, who's going to control that digital currency? The market? That's not good for any global economy. The UK Bank, the Bank of China, and the US Federal Reserve would not allow that to happen.
We've been here before, actually, because last 13 years, it's been a low rate environment and it's been hard to even find inflation. So the fact we have a little bit of inflation is what causes a lot of this concern. But from a historical perspective, this little bit of inflation really is very small compared to historically what we've experienced in the past.
Thank you. That's an awesome point. We've become, I referenced it earlier, we've become desensitized to a slight increase in inflation or interest rates because we've had so low interest rates for so long. Karen, I hope you're raising your hand so you can ask a question.
All right. So what is the difference in America that prevents us from being like, I think it's Venezuela, where it's just crazy? What makes us different?
Okay, great question. So in Venezuela, that's a good example. Venezuela has a democratic sort of government, but they are subject just politically to all sorts of whims, right? So if you, let's just take an example. You bought a piece of real estate in Venezuela, or you ran a company in Venezuela. One thing, Venezuela's economy is much smaller than the US, but you can't count on the government acting as they promised they would, either from an ownership or from an economy standpoint. They might do something crazy, like go borrow tons of money. And so we have compared to China. So our economy compared to China from a gross domestic product, we still dwarf China, although China's got loads and loads of people. So from a demand standpoint, we live higher than anybody else from a standard of living, which means we consume a lot, Karen, a lot more than folks do in Venezuela. So when people want to sell stuff, they want to sell it to the United States, and they want to be paid in dollars, or they want to pay in dollars because they know that value is going to be fairly constant because of our form of government, because we're so large, because we've got a great track record, unlike Venezuela. Does that help? Okay, good. I see one a question here. The equity multiple appears to have expanded over the last decade based on expected low interest rates forever, as all countries appear broke. If inflation goes higher and interest rates increase, would the multiple not contract perhaps materially? Yes, Vince. Couple things there. One, as I mentioned earlier, what's driven stocks or equity multiples in large part over the last 10 years is there's not an alternative. Are you going to accept 0.6% for 10 years on a US Treasury bond? No, you're going to go put your money in Southern Company, which is the example I used. So that has absolutely been a tailwind for the equity market. I think what's in your question, Vince, and if it's not, just unmute yourself, is the US debt, which has ballooned. And our debt, because of stimulus and a lot of other things, we have benefited as a country. This is touching on your question too, Karen. We have benefited as a country because our debt service on the US government debt has been incredibly low, unbelievably low, because interest rates have been so low. One of the fears is if interest rates normalize, instead of paying 0.6 or 1.6% on US debt, if we have to pay 3 or 3.5% on our US debt, that's going to be a problem for the United States. And things like infrastructure, which we desperately need to spend money on, are going to be challenged.
Gene,
Yes.
I'll follow up that question.
Good.
And I understand inflation, and particularly for those of us old enough to remember Jimmy Carter, we definitely have that fear factor somewhere in our mind. But to me, I mean, you kind of touched on what I believe is something that I find more concerning is the fact that and you touched on it. I mean, we're locked into a low interest rate perspective for a long time, and that's with $26 trillion of debt, and that's before considering Social Security that will be a disaster in 10 years in infrastructure. I mean, is that something that I guess we just stick with asset allocation because there's really no other alternative, or or do you have some thoughts about how like the country's going to navigate the storm?
Good question. Thank you, Vince. As we talk amongst our team, it's very important for us for asset allocation and performance to be good, and we want to be competitive in that. But one of our biggest mandates is really risk management. For all of you who are clients and all of you who are soon to be clients, managing risk is as important and sometimes more important than performance. And I think it directly speaks to your question, Vince. We are very concerned about the amount of debt that the US government has and a rise in interest rates and how that's going to affect us. Are we going to take a position, a large position, take someone out of their asset allocation because we're that concerned about it? No. Will we hedge some things? Perhaps yes. For those of you that know, we've held a little bit more cash in portfolios rather than bonds. Not because we weren't buying stocks, we kept that allocation, but we were a little cash heavy because we figured at some point interest rates were going to move up. So we didn't change anybody's asset allocation, but we hedged it a little bit. So Vince, we're not going all in on gold or anything like that because we think the United States is going to hell in a handbasket. And if we go to hell in a handbasket, that's a problem for the rest of the world as well.
Yeah, and I agree with the perspective that everything's relative. That the United States is still probably relatively better than a lot of countries. If that makes us sleep better at night. But in terms of, do you think, I mean, again, this is just an opinion. I mean, nobody knows it perfectly, but do you perceive that the market is overvalued today? I mean, even with a little bit of contraction in the Dow, but do you think that, with the penny multiplier today and earnings and, some of the challenges in, the immediate future, would you be, do you think that stocks are fairly valued, overvalued, or undervalued?
I'm going to give an answer you don't want to hear, but it's my honest answer. I don't know. And let me back that up. One of the things that we saw 3 months ago, and we all saw it, was equity values coming out of a global pandemic went through the roof. And we're kind of scratching our heads, but we knew what was happening. The stock market is a weighing machine. It's looking ahead. It's not looking back. So it was looking ahead to earnings. So it was really interesting that first quarter earnings came in as expected. 90% of the companies reported earnings, and we've seen the equity markets stay about where they are and actually rise a little bit. So earnings have beat. Will they continue to beat? I don't know, Vince, but a well allocated portfolio is going to help you manage your risk. So I wish I could say yes, no. I think we're probably, if you pinched me, I'd say we're probably fairly valued. But I would have said before we hit the COVID virus in December, we were sitting around saying we can't go on like this, and we're 15% above where we were before we entered the COVID. So,
Hey, Gene.
yes, sir.
I'd add to that too, that, now we've talked a lot about in the investment committee meetings, sectors, specific sectors today more than ever before are more either, stretched valuations or not stretched valuations. So COVID just had a really interesting impact on the overall economy, and certain sectors got hammered and certain sectors have thrived. I mean, they've shot through the roof. And so today's environment's a little bit different. So when you look at like the S&P just as a whole, or these broad market indexes, today more than any, it's hard to just take a step back and say the market is overvalued, undervalued, fairly valued based on a broad market index, because you really have to know what sectors to have a real good feel of is today. It's a lot harder to just take the 5,000 level overview when you're managing a portfolio because of the impact on sectors in the COVID crisis.
And I'll make a comment that from our investment policy committee meeting, one of the quotes was, "We don't see any fat pitches." So in other words, we don't see any screaming values out there. Are we overvalued? Not necessarily, but unlike energy, which 6 or 9 months ago when gas was $2 a gallon and oil was at $30 a barrel, we knew that would eventually come up despite the move towards electricity, electric cars, and those sorts of things. We do not see a lot of fat pitches right now. Good questions. Good. I love it. Very good. Any others? Anything out there on your mind? Well, I will wish you all good health and happiness. Please, if you were shy about asking a question, you know how to get us. We're happy to chat about this stuff. We love to nerd out about it and go on and on and on. And some people would call it pontificating. As always, if you know someone who might benefit from this, someone who's nervous about inflation, go to our website and they can go take a peek at this video, and hopefully it'll make them feel a little bit better. Thank you all for joining us. We're very happy that you're here. And most of all, thank you for the questions. Take care, everybody.